Disclaimer.
Today, February 2nd, 2026, the financial system as we knew it officially ceased to exist. While you were sleeping, gold plummeted 21%, and silver took a shocking 41% dive. But don't believe the charts on your phone. This isn't a market correction. This is the first ever synchronized attack from both the West and the East. While the CME delivers a margin strike in the United States, the Chinese platform JieWoRui has frozen $19 billion in physical metal, leaving investors with a pathetic 20 cents on the dollar. In this video, I will prove to you that this coordinated crash was planned on both sides of the ocean, and why what you hold in your hands today is the only thing you truly have left. The attack came 3 days ago on a Friday. January 30th, 2026, silver plunged from $120 to $78 in a single trading session. The worst day for the white metal since March 1980. Gold dropped from $5,600 to $4,700. Paper markets called it profit-taking after Kevin Warsh's Fed chair nomination. But while everyone watched the paper price collapse, something else was happening that nobody wanted you to see. The physical metal had been disappearing for weeks. 10 days before the crash, on January 20th, thousands of investors in Shenzhen, China tried to access their accounts on a platform called JieWoRui. The login screens froze. The withdrawal buttons stopped working. 13.4 billion yuan vanished from view. 1.85 billion American dollars locked away from people who thought they owned precious metals. One investor alone had $820,000 trapped inside the system, and the platform offered him 20% compensation, as if losing 80% of your wealth is just the cost of doing business. But here's what they didn't tell him, what they are not telling any of us right now. JieWoRui operated on something called a pre-priced gold fractional model, which sounds sophisticated and legitimate until you understand what it actually means. They never had the full metal backing for what they sold. Have you ever wondered how these platforms can offer such competitive pricing and instant liquidity? It's because they're running the oldest scam in the financial playbook, dressed up with blockchain buzzwords and mobile apps. They promise you own metal, but what you really own is a promise that someone else owns metal, and that someone else made the same promise to 10 other people. It's musical chairs with precious metals, and the music just stopped for JieWoRui's customers. But here's where this story gets much bigger than one platform in southern China. That same week, multiple Chinese precious metals platforms collapsed in what can only be described as a coordinated implosion. Yudiandang shut down without warning. Baoma locked its doors. And perhaps most revealing, the UBS SDIC Silver Fund halted all trading despite showing a 36% premium over the actual spot price of silver. Let that sink in. People were so desperate to get real metal that they were willing to pay 36% above market price, and the fund still had to freeze redemptions. Why would that happen unless there's no metal to deliver? The Shenzhen government task force investigating these collapses didn't classify them as investment platforms or commodities exchanges. According to their official statements, they're treating them as gambling operations disguised as gold trading. That language matters because it reveals what regulators discovered when they looked under the hood. These weren't legitimate bullion dealers who hit a rough patch. They were fractional reserve schemes that worked perfectly fine as long as nobody asked for their metal back all at once. Now you might be thinking this is a China problem, some emerging market chaos that doesn't affect our markets here in the United States. Pop quiz. Between mid-January and the crash, what was happening at the Chicago Mercantile Exchange, the backbone of North American precious metals trading? 33.45 million ounces of silver physically withdrew from COMEX registered vaults in just 7 days. That's 26% of the entire registered inventory walking out the door in a single week, leaving only 113 million ounces available for delivery as we entered February. Let me put that in perspective for you. Registered inventory is supposed to be the metal available for immediate delivery against futures contracts. It's the actual physical silver backing. The paper promises traded on the exchange. When a quarter of it disappears in 7 days while paper prices are hitting record highs before the crash, that's not normal profit-taking or portfolio rebalancing. That's someone who knows something, draining the vaults before the paper market collapses. And the timing reveals everything. During the January 30th crash that took silver from $120 to $78, buyers in Shanghai were paying $90 to $100 per ounce for actual metal, a 12 to 17% premium over the crashed paper price. Think about what that means. The paper market says silver crashed 35%, but the physical market says silver is worth 20 to 30% more than the crashed price. These aren't just different markets pricing things differently. This is a complete divorce between paper promises and physical reality. Our financial system has trained us to trust price signals, to believe that markets efficiently discover true value through the wisdom of crowds. But what happens when the crowd trading paper has no idea that the physical metal backing those paper contracts is disappearing? You get exactly what we're seeing right now. Paper prices crashing while physical premiums explode, platforms freezing withdrawals while vaults drain, and investors learning the hard way that ownership and possession are two very different things. The JieWoRui investors who got locked out discovered this truth in the most brutal way possible. They thought they owned gold and silver. What they actually owned was a fractional claim on gold and silver that might exist, backed by a platform that operated more like a casino than a commodity exchange. The 20% compensation offer reveals how the math really worked. If the platform truly held the metal they claimed, why not just return it? Why offer pennies on the dollar unless the vault is mostly empty? This fractional reserve model isn't new. Banks have operated on fractional reserves for centuries, keeping only a small percentage of deposits on hand and lending out the rest, betting that not everyone will ask for their money simultaneously. But there's a critical difference between fractional reserve banking and fractional reserve precious metals. When a bank faces a run, central banks can print more currency to backstop the system. When a metals platform faces a run, nobody can print more gold and silver. Either the metal exists in the vault or it doesn't, and when it doesn't, the entire illusion collapses. What's terrifying about January is that all of these collapses happened within days of each other. Then the paper market crashed 2 weeks later. JieWoRui freezes on January 20th. Other Chinese platforms shut down the same week. COMEX vaults drained 26% of registered silver in mid-January. Then, on January 30th, the paper price crashes 35%, while Shanghai premiums spike to 17%. This isn't coincidence. This is what it looks like when multiple parts of a fractional system realize simultaneously that they're all making promises they can't keep. The exchanges use the first convenient excuse, a Fed chair nomination, to orchestrate a coordinated margin hike assault that crashes paper prices while physical metal trades at massive premiums. You need to understand what fractional collapse looks like in practice because it's not like a stock market crash where everything drops together and recovers together. It's more like watching dominoes fall in slow motion, where each platform or exchange has to make an impossible choice: admit they don't have the metal and face complete destruction, or freeze the system and hope nobody notices the metal never existed. JieWoRui chose to freeze. Other platforms chose to shut down entirely. COMEX chose something different. They raised margins 8 times to crash the paper price while the physical metal disappeared from vaults, but the outcome is the same. People who thought they owned metal are discovering they own promises, and promises don't keep their value when everyone tries to redeem them at once. The investors, still trapped in these frozen platforms, are learning an expensive lesson that every one of us needs to understand right now. When you buy precious metals through a platform that offers instant liquidity, fractional ownership, and prices that seem too good to be true, you need to ask yourself one critical question. Where is the actual metal? Not where does the platform claim it is, not what the digital ledger says you own, but where could you physically go right now to pick up your silver or gold? If the answer is nowhere, or if the answer involves multiple layers of custodians and sub-custodians and beneficial ownership structures, then what you own isn't metal. It's a derivative of metal, a financial product backed by the promise that someone somewhere holds metal on your behalf. And as JieWoRui's customers discovered on January 20th, when the system comes under stress, those promises evaporate faster than morning fog in the desert sun. The $19 billion that vanished is not just sitting in some frozen account waiting to be released when regulators sort things out. Much of it never existed as metal in the first place. It existed as numbers in a database, claims on a system that worked beautifully, as long as the majority of customers never asked to convert those claims into physical possession. The moment too many people wanted their metal, the entire structure revealed itself as the fractional scheme it always was. And while we're still processing what happened in January, the platform freezes, the vault drains, the coordinated paper crash on January 30th that everyone blamed on Fed policy, we need to ask ourselves an uncomfortable question. If these fractional schemes could collapse so completely in Shenzhen while COMEX vaults hemorrhaged metal, what makes us think the crisis is over? The math is the math. The laws of physics apply equally everywhere. You can't deliver metal you don't have, no matter how sophisticated your exchange, how regulated your marketplace, or how many margin hikes you orchestrate to crash the paper price. The metal disappeared before the crash, and the question we need to answer right now is, where did it go, who has it, and why can't they return it? Everyone wants to talk about the margin hikes. 8 margin increases in 8 weeks on COMEX silver futures, compared to just 7 total in the previous 3 years. Financial media called it risk management, a prudent response to volatility. But that's the cover story they want you to believe, and it's designed to keep you focused on the wrong question. The margin hikes weren't the weapon. They were the cleanup operation, after the metal was already gone. To understand what really happened, we need to go back to January 1st, 2026, the day China activated the Great Silver Wall. New export licensing requirements went into effect that morning, restricting 60 to 70% of global refined silver supply to just 44 government-approved companies. According to data from China's Ministry of Commerce, export volumes dropped 40% almost immediately. This wasn't a gradual policy shift. This was a door slamming shut on global supply chains that had operated for decades. Think about the timing for a moment. JieWoRui operated on 40-to-1 leverage, allowing customers to lock in future silver prices by posting just 1/40th of the spot price. They promised physical delivery, ran sophisticated apps with real-time pricing, and processed withdrawals smoothly for months. Then January 1st arrives, China restricts silver exports, and 20 days later the platform freezes with 13.4 billion yuan in unpaid obligations. That's not coincidence. That's a business model that depended on unlimited access to Chinese refined silver, discovering that the unlimited part just ended. Here's what nobody's telling you about these Chinese platforms. They weren't just selling paper claims. They were running a geographic arbitrage scheme that only worked as long as metal flowed freely from Chinese refineries to global markets. When customers wanted delivery, platforms like JieWoRui could source physical metal domestically at competitive prices, ship it out, and pocket the spread. But starting January 1st, that metal became trapped inside China's borders, unless you were one of 44 licensed exporters who met strict annual production minimums of 80 tons and maintained $30 million credit lines. According to reports from Bloomberg and multiple Chinese financial outlets, Shenzhen's Luohu district government formed a special task force to investigate JieWoRui not as an investment platform, but as a gambling operation disguised as gold trading. That language matters because it reveals what investigators found when they examined the books. The platform wasn't hedging customer positions with physical inventory. They were running a leveraged betting pool where most customers' money never touched actual metal, and the few who demanded delivery were paid with new customer deposits until the music stopped. But if JieWoRui couldn't get metal out of China anymore, who was getting it? Follow the physical flows and you'll see exactly where 33.45 million ounces went when they left COMEX vaults in mid-January. The Shanghai Gold Exchange premium tells the story. While silver crashed from $120 to $78 on January 30th, a 35% paper collapse, physical buyers in Shanghai were paying $90 to $100 per ounce. That was a 12 to 17% premium over the crashed paper price for actual metal you can hold in your hands. Let me put this in terms that matter to you personally. Imagine you're a solar panel manufacturer in Germany or a semiconductor producer in Taiwan. You've watched silver climb all year. You've seen China implement export restrictions on January 1st. And you know your production lines need a steady supply of the white metal to function. When paper silver crashes 35% on January 30th, do you celebrate the lower prices and wait to buy? Or do you panic and secure physical metal immediately before it disappears completely, even if that means paying premiums well above the crashed paper price? The answer is obvious, and the Shanghai premium proves it. According to data from the Shanghai Gold Exchange and multiple bullion dealers tracked by Bloomberg Physical Silver in China, traded at premiums exceeding $8 per ounce in late December, and those premiums expanded to 12 to 17% over spot during the January 30th paper crash. Industrial buyers aren't stupid. They know paper prices can be manipulated with margin hikes and coordinated selling. They care about one thing. Can you deliver physical metal to our facility, and how much do we need to pay to guarantee supply? The COMEX market structure reveals even more about the desperation for immediate metal. Silver futures went into backwardation, meaning spot prices traded above futures prices, the opposite of normal market conditions. In a healthy commodity market, futures trade at a premium to spot because there's a cost to store and finance physical inventory over time. When that relationship inverts and spot trades higher than futures, it signals one thing: desperate demand for metal right now, not promises of metal in 3 or 6 months. Data from the CME shows silver lease rates, the cost to borrow physical metal, spiked to 8 to 10% in January compared to the normal rate of around 0.5%. Think about what that means in practical terms. Someone needs silver so badly they're willing to pay 10% annual interest just to borrow it for immediate use. That's not normal trading activity. That's a shortage so severe that participants will pay almost any price for possession. Now, here's where the coordination becomes impossible to ignore. The CME implemented 8 margin hikes in 8 weeks leading up to and during the January crash. The Shanghai Futures Exchange mirrored those moves, raising silver margin requirements to 20%. But look at the timing. These margin increases didn't come before the price rally to prevent speculation. They came during and after record highs when long positions were most profitable. That's not risk management. That's a coordinated effort to force profitable longs to liquidate positions before they could demand delivery in March. According to Shift Gold's analysis of COMEX delivery data, registered silver inventory available for delivery has dropped to 113 million ounces as of late January, down from over 300 million ounces at its peak. Meanwhile, open interest for March contracts, the next major delivery month, remains elevated despite the margin pain. CME Group data shows that March 2026 silver futures open interest sits well above typical levels for major delivery months, indicating that despite 8 margin hikes designed to shake out speculators, determined buyers are holding positions and preparing to demand metal. The math here is simple but terrifying. March contracts represent roughly 528 million ounces of silver promises. COMEX vaults hold 113 million ounces in registered inventory. That's a 4.67-to-1 ratio between promises and deliverable metal. But even that understates the problem, because much of what's classified as registered is already encumbered, pledged as collateral, or held in forms that can't quickly be delivered against futures contracts. Industry analysts estimate the actual deliverable pool may be under 80 million ounces. You might be wondering why exchanges and banks would allow this situation to develop. The answer is they didn't allow it. They couldn't prevent it. China's January 1st export restrictions removed 60 to 70% of global refined silver supply from the equation overnight. Industrial demand doesn't stop because paper prices crash. Solar panel production, semiconductor manufacturing, electric vehicle components, these industries need physical silver regardless of what futures contracts trade for in Chicago or New York. When Chinese platforms like JieWoRui collapsed, they exposed the fractional nature of the entire paper silver system. These platforms promised metal they didn't have, counting on access to Chinese refinery output to satisfy the small percentage of customers who demanded delivery. The moment China closed that door, the fraud became obvious. But if Chinese retail platforms were running 40-to-1 leverage on non-existent metal, what makes you think Western exchanges operate any differently? The coordination between East and West becomes crystal clear when you map the timeline. January 1st, China activates export restrictions. Mid-January, COMEX vaults drain 26% of registered inventory in 7 days. January 20th, JieWoRui and multiple Chinese platforms freeze withdrawals. January 28th, Shanghai Gold Exchange raises margin requirements to 20%. January 30th, paper prices crash 35% on Kevin Warsh Fed chair nomination news, while Shanghai physical premiums spike to 17%. This wasn't a series of unrelated events. This was a coordinated de-risking operation where exchanges on both sides of the Pacific raised margins simultaneously to prevent delivery demands from exposing that there is not enough physical metal to satisfy even a fraction of outstanding paper claims. The Warsh nomination provided perfect cover, blamed the crash on Fed policy concerns rather than acknowledge the structural shortage that's been building for months. Here's what should terrify anyone holding paper silver positions instead of physical metal. According to industry data compiled by the Silver Institute, the global silver market has run a deficit, meaning industrial and investment demand exceeded new mine supply, for 5 consecutive years. The cumulative deficit tops 1.3 billion ounces since 2019. Where did that billion ounces come from to satisfy demand? It came from above-ground inventories in exchange warehouses, government stockpiles, and recycled material. Those sources are now depleted. The January 30th crash and coordinated margin hikes served one purpose: scare retail investors into selling paper positions before March delivery demands reveal that Western vaults are as empty as JieWoRui's promises. Professional traders and industrial users aren't selling. They're pulling metal from warehouses at the fastest pace in years, paying premiums well above spot prices, and preparing for a shortage that exchanges can't fix with margin hikes or coordinated selling. You need to understand what backwardation means for your investment decisions. When spot silver trades above futures, when lease rates hit 10 times normal levels, when physical premiums expand during paper price crashes, these are not signs of a healthy market correcting to fair value. These are symptoms of a system where paper promises vastly exceed physical reality, and the smart money is quietly exiting paper claims for actual possession before everyone realizes the emperor has no clothes. The metal didn't disappear, it moved. It moved from COMEX vaults to private storage. It moved from Chinese platforms that couldn't deliver to buyers willing to pay premiums for guaranteed possession. It moved from the hands of speculators who got shaken out by margin hikes to industrial users who need physical supply regardless of price. And most importantly, it moved from a system built on fractional promises to the possession of those who understand that in a shortage, paper claims are worth exactly what JieWoRui's customers are discovering, 20 cents on the dollar if they're lucky. March 27th, 2026. Mark that date because it's when the lies stop working. That's first notice day for COMEX. March silver contracts, the moment when longs who have held through 8 margin hikes and a 35% paper crash can finally demand delivery of the metal they have paid for. And based on current positioning, the exchanges are terrified of what happens when delivery demands hit a system that's already hemorrhaging inventory. Here's the math that keeps COMEX officials awake at night. March 2026, silver contracts represent approximately 528 million ounces of promised delivery. COMEX registered vaults currently hold 113 million ounces available for delivery. That's a 4.67 to 1 ratio between paper promises and physical metal. But that ratio, as bad as it sounds, actually understates the crisis they're facing. Industry analysts who track warehouse receipts and delivery eligibility report that much of the registered inventory is already encumbered, pledged as collateral for other positions, tied up in lease arrangements, or held in forms that can't quickly be mobilized for delivery against futures contracts. When you strip out the non-deliverable metal, the actual pool of silver that can be delivered against March contracts may be under 80 million ounces. That changes the ratio from 4.67 to 1 to over 6.6 to 1, and potentially worse. Now, apply what we learned from JieWoRui's collapse. That platform froze when customers demanded delivery of metal that never existed. They offered 20% compensation because they didn't have the 80% they'd promised. If just 15 to 18% of March contract holders demand delivery, not even a majority, just a meaningful minority, the entire COMEX system faces the same impossible math. You can't deliver 528 million ounces when you only have 80 million ounces that are actually deliverable. But here's what should tell you everything about why the coordinated attack happened when it did. The January 30th crash, and 8 weeks of margin hikes before it weren't designed to prevent a future squeeze. They were emergency measures to survive a current shortage that's getting worse by the day. 3 factors converged in January that made this moment uniquely dangerous for exchanges running fractional metal schemes. First, China locked 60 to 70% of global refined silver supply behind export restrictions on January 1st. That's not a policy that phases in gradually. It took effect immediately. Companies that had relied on Chinese refined silver for decades suddenly found themselves competing for 44 licensed exporters, who now answer to Beijing's Ministry of Commerce, not market demand. The Industrial and Commercial Times reported that licensed exporters must maintain annual production capacity of at least 80 tons and credit lines of $30 million, effectively consolidating silver exports into state-controlled hands. Second, we're heading into peak industrial demand season. April through June represents solar panel production's busiest period as manufacturers race to complete installations before summer. According to Silver Institute data, solar applications alone account for roughly 20% of annual silver consumption, and that demand doesn't stop because paper prices crashed. If anything, lower paper prices make industrial users more aggressive about securing physical supply before prices recover or availability tightens further. Third, vault drains are accelerating, not slowing. The 33.45 million ounce withdrawal in 7 days during mid-January was not an anomaly. It was a symptom of accelerating demand for physical possession. According to data tracked by ShiftGold and Seeking Alpha analysts, registered silver inventory has dropped consistently since September, falling from over 150 million ounces to 113 million by late January. The trend is worsening, not improving. Connect these 3 factors, and the timing of the coordinated attack makes perfect sense. China closed the supply door on January 1st. Industrial demand season approaches in April. Vault drains are accelerating through January and February. March 27th is first notice day. They had to crash the paper price and terrify retail investors into liquidating positions before delivery demands in March exposed that Western vaults are running the same fractional scam that just destroyed JieWoRui. The 8 margin hikes served a specific purpose: force maximum liquidation from leveraged speculators while preserving the fiction that exchanges can deliver metal. Every trader who got margin called and liquidated their position is one less potential delivery demand in March. Every retail investor who panic sold during the January 30th crash is one less threat to the fractional reserve system. The coordination with Shanghai raising margins to 20% simultaneously ensured that Eastern and Western markets applied maximum pressure at the same time. But here's what the exchanges can't control: professional traders and industrial users who understand what's happening. According to CME Group's own data, March open interest remains elevated despite 8 margin hikes specifically designed to shake out longs. That tells you sophisticated players are holding positions through the pain because they know something retail investors are missing. March delivery represents their last chance to extract metal from a system that is running on fumes. Think about the incentives from an industrial user's perspective. You're a solar panel manufacturer who needs consistent silver supply for the next 12 months. You've watched China implement export restrictions. You've seen platforms collapse when delivery demand exceeded available inventory. You've observed COMEX vaults drain 26% in a single week. Paper prices crashed 35%, but physical premiums expanded to 17% over spot. What do? You hold your March contracts and demand delivery regardless of margin requirements, regardless of paper price volatility, because the alternative is discovering in April that there's no metal available at any price when your production lines need it. Industrial users can't afford to wait and see if the shortage resolves itself. They need guaranteed supply, and March delivery is their last opportunity to extract metal from COMEX vaults before the system potentially freezes like JieWoRui did. The exchanges understand this, which is why the attacks have been so coordinated and aggressive. But there's a fundamental problem with trying to scare industrial users into not taking delivery. They can't afford to be scared. A solar company that misses production targets because they don't have silver faces existential business risk. Better to pay elevated margins and defend positions through volatility than explain to shareholders why the factory is idle because they tried to save money on paper contracts. So what should you be watching as we approach March 27th? 3 indicators will tell you whether the system survives or breaks. First, watch the Shanghai premium. It's currently running 12 to 17% over crashed paper prices. If that premium widens past 15% and holds there, we're seeing complete decoupling between physical and paper markets. At that point, paper prices become irrelevant. What matters is whether you can source physical metal at any price. Second, watch physical dealer premiums in the West. Major bullion dealers are currently charging $8 to $12 per ounce over spot price for physical silver, even after the 35% paper crash. That premium should have collapsed if the crash represented real selling pressure. Instead, it's holding or expanding, which signals that physical buyers don't believe paper prices reflect true supply and demand. If dealer premiums push past $15 over spot, that's confirmation that the paper market has lost all credibility with physical buyers. Third, watch March open interest as we approach first notice day. Currently, it's elevated relative to typical major delivery months, despite 8 margin hikes. If open interest stays elevated or increases as we get closer to March 27th, that confirms our thesis. Sophisticated players are holding for delivery regardless of paper price volatility. If open interest collapses, the exchanges succeeded in scaring enough longs away to survive another month. Technical levels matter less in a market this divorced from fundamental reality, but for those tracking paper prices, gold support sits around $4,400 and silver around $72 based on pre-crash consolidation zones. However, these levels are largely meaningless when physical trades at 12 to 17% premiums over paper. The real market is the physical market, and that market is signaling severe shortage regardless of what paper contracts trade for in Chicago. Here's what survivors need to understand about positioning for the next 3 months. The January 30th crash and coordinated margin attacks had one purpose: separate paper traders from physical holders. Before delivery demands exposed the fractional system, paper traders got annihilated exactly as intended. Many sold at losses during the crash, took massive margin hits, or got stopped out of positions that would have been profitable if they'd held through delivery. Physical holders, those who took possession before the attack, or who held exchange positions through the margin assault to demand March delivery, are positioned for a China-driven shortage spike in the second quarter of 2026. Industrial demand season runs April through June. Chinese export restrictions remain in force through at least 2027. COMEX vaults are at multi-year lows with accelerating drain rates. The math doesn't work unless paper prices eventually reflect physical reality. But, and this is critical, timing matters enormously. The exchanges have proven they can coordinate violent paper attacks to defend the fractional system. They can raise margins 8 times in 8 weeks. They can orchestrate 35% crashes on convenient news like Fed chair nominations. What they can't do is create physical silver that doesn't exist. They can delay the reckoning, make it painful for anyone holding paper positions, and shake out weak hands repeatedly. That's why the JieWoRui collapse is such a perfect parallel for what we're watching in real time. Those Chinese customers thought they owned metal. They held accounts, showing balances, had withdrawal histories proving the platform worked, and believed their claims would be honored. Then delivery demand exceeded available inventory, and they discovered their claims were worth 20 cents on the dollar. The platform did not fail because of market volatility or Fed policy or margin hikes. It failed because the metal never existed. COMEX won't announce a freeze the way JieWoRui did. Western exchanges will use more sophisticated methods: force majeure declarations, cash settlement options, additional margin requirements that make delivery economically impossible, or regulatory interventions that change delivery rules mid-contract. But the result is the same: paper claims discovering they are worth a fraction of promised value when physical metal is unavailable to deliver. The China export restrictions that activated January 1st aren't temporary market disruptions. According to official announcements from China's Ministry of Commerce, the licensing framework runs through 2027 with no indication of reversal. That's 2 full years of severely restricted silver exports from a country that controls 60 to 70% of global refining capacity. This isn't a problem that resolves itself in weeks or months. Meanwhile, the cumulative supply deficit continues expanding. The Silver Institute's analysis shows 5 consecutive years of deficits totaling over 1.3 billion ounces. That metal came from somewhere, It came from exchange, warehouses, government stockpiles, and recycled material that's now exhausted. You can't run billion-ounce deficits indefinitely while simultaneously restricting 70% of refining capacity and expect the system to function normally. March 27th is first notice day, but the crisis extends well beyond a single delivery month. Even if exchanges survive March through cash settlements, force majeure, or regulatory intervention, the fundamental shortage persists into April, May, June when industrial demand peaks. Every month that passes, with China's export door closed, with vault inventories declining, with physical premiums expanding over paper prices, the eventual reckoning becomes more severe. For those holding physical metal, the strategy is clear. Maintain possession and ignore paper price volatility designed to shake your conviction. The attacks will continue. More margin hikes, more coordinated crashes, more media narratives about profit-taking and risk management. None of it changes the fundamental equation. There isn't enough deliverable metal to satisfy paper claims, and China just removed most of the supply that could have papered over the shortage. For those still in paper positions, March 27th represents a binary outcome. Either you demand delivery and test whether COMEX can actually provide metal, or you accept cash settlement and hope to buy physical later at what will likely be much higher real prices. There's no middle ground when a fractional system faces delivery demands it can't satisfy. The $19 billion that vanished from JieWoRui, the 33 million ounces that drained from COMEX vaults, the coordinated margin attacks from Chicago to Shanghai, these aren't separate stories. They are symptoms of a global fractional reserve system built on promises, discovering that promises can't satisfy industrial demand for physical metal. And in 45 years of following precious metals markets, we've never seen both East and West coordinate attacks this aggressively on the same timeline. What you hold in your hands today is the only thing you truly have left. Everything else is a claim on a system that just showed you through JieWoRui's collapse and COMEX's desperate margin assault. That paper promises are worth exactly what fractional schemes always deliver when the music stops. Pennies on the dollar and hard lessons about the difference between ownership and possession. The $19 billion freeze in China was just the first domino. While the paper markets burn, remember, if you can't hold it, you don't own it. The CME and Shanghai have made their move. Now it's time to make yours. Stay strapped, stay physical, and watch the next video before they pull the plug on that too.